Well, our featured guest, Brooke Thackray, says falling inflation has put downward pressure on profit margins. He says if profit margins decline further, this will weigh on corporate earnings and on stock prices. Brooke.
Yeah, we've seen profit margins actually, they rocketed higher coming out of, the COVID to really record levels. And what was happening there was corporations were taking advantage of inflation. They were saying, well, inflation is going up, let's boost our prices up. And they're trying to stay ahead of inflation. And consequently, what we saw was profit margins go higher. And here's the graph of profit margins, and you can see that it generally regresses. On average, it's around 8%, and you can see here that we're higher than that, and we rocketed higher in 2021 to really record levels. And as inflation has been receding, we can see that profit margins have come back down a little bit. And also, consumers don't have as much money to spend. So that's starting to squeeze corporations as far as how they can price. So right now, what we can probably expect is profit margins to go down further. And so if we're taking a look at the stock market, so how does this impact the stock market? This impacts it because if profit margins come down, that means the P and the E basically is declining. And so the price to earnings ratio is actually, that's going to be hit. So this isn't a good scenario, I think, longer term as far as the prospects for stock prices, because the profit margins are going to head a little bit lower.
That may surprise a lot of viewers because they have been told that rising interest rates are negative for stock markets, and that declining interest rates are good for stock markets. And in fact, the big rally that we saw beginning in the late October last year was triggered by a pretty clear signal from the U.S. Federal Reserve Board that the direction of interest rates will be down. Absolutely,
sure. In the short term, falling interest rates is good for the market. But I got to tell you, and we've seen this in the past before, when at a certain point, if, let's say the Fed starts to cut sometime later on this year, that may boost the market in the short term. But if they keep continually cutting, that means the economy's in trouble, and it's like pushing on a string. No matter how low interest rates go, it's going to be very difficult for consumers to keep spending. It just says that the economy's in trouble. So this is different with the profit margins, because if interest rates fall down, that's different. Companies are going to be having to lower their prices in a competitive environment because consumers don't have enough money to spend if interest rates are heading down.
Do you expect much commentary on this in corporate earnings reports or conference calls?
I don't right now. I don't think that's really where they're focused on right now. They're more focused on what's happening as far as their growth levels go and inflation, but not the profit margins themselves.
What about sectors? Are there some sectors where the pressure may be heaviest?
Well, I think, the discretionary right now is still doing quite well, but I think the consumer discretionary. But down the road, that's probably the sector to look at as far as when we start to see a little bit of trouble. Perhaps when the unemployment rate starts to increase, then all of a sudden we might start to see people cutting back on their consumer discretionary products instead of taking trips or whatever it is. And the profit margins would probably squeeze there first.